Welcome back to the deep dive. Okay, so if you've ever, tried to get your head around financial derivatives, you pretty quickly hit these two big categories, stock options and commodity futures. They can seem really complicated. So today, we're trying to cut through that complexity for you.
Yeah, and we can do that, I think, because underneath all the surface differences, stocks versus soybeans or whatever, there's actually one single fundamental idea, and that idea really dictates everything else. It's the difference between having and having an obligation.
Right, versus an obligation. Okay, that feels like the key then. Let's start right there. Options are what people call contingent claims.
Exactly. Think of it like, well, maybe like buying a very specific kind of ticket or voucher. The person buying it pays a price up front, and what they get for that price is the right, but crucially, not the requirement, the choice to buy or sell something later at a fixed price.
So the payoff depends entirely. It's contingent on whether they actually use that right.
Precisely. They might use it, they might not. It depends if it makes financial sense for them when the time comes.
Okay, so that's the right part. How do futures compare? What's the obligation side look like?
Futures are, well, the complete opposite in that sense. They're forward commitments. It's like a firm contract, a binding agreement. Both people involved, the buyer, who we call long, and the seller, short, are obligated. They must complete the transaction down the road at the agreed price. No backing out, unless you manage to sell your contract to someone else beforehand.
Right, no choice involved there. Okay, let's unpack the immediate money side of this, right, versus obligation. How does that actually shape the potential profit or loss?
Okay, with options. Because the buyer gets that valuable choice, they have to pay for it. That payment is the premium. It's non-refundable. And this premium payment is what creates the really famous asymmetric payoff structure for options.
Asymmetric, meaning what exactly for the person buying the option? Their risk.
It means their risk is completely locked in and known from the start. The absolute maximum they can lose is the premium they paid. That's it. If the market goes the wrong way, they just let the option expire worthless, loss capped. But if the market moves strongly in their favor, their potential profit can be, well, quite large. For certain options, like a long call, it's theoretically unlimited.
Okay, limited loss, potential for big gains. Now, contrast that with futures. You said both sides are obligated.
Yep, both are locked in. And because of that, you get a perfectly symmetric linear payoff.
Symmetric, so mirror image.
Exactly. For every dollar the long side makes, the short side loses a dollar, and vice versa. It's a direct dollar-for-dollar transfer based on price movement. And here's the kicker. Because you have to see the transaction through, regardless of how bad the price move is against you, the potential loss and potential profit are effectively uncapped. Unlimited, potentially, for both the buyer and the seller.
Okay, hold on. If both sides face potentially unlimited losses, how does the market even function? How do you guarantee people can actually pay up if things go badly wrong? That sounds, risky.
It is, and that's where margin comes in. But margin in futures is really different from, say, buying stock on margin. It's not a down payment. It's required from both parties. Think of it as a performance bond, a good faith deposit.
A deposit to show you can cover potential losses.
Basically, yes. And because those losses can mount quickly and are potentially unlimited, there's another crucial mechanism, mark-to-market.
Mark-to-market, right. Sounds important, maybe a bit technical. What does that actually mean for a trader day-to-day?
It means your account balance is updated literally every single trading day based on the day's price movements. If the market moves against you and your margin account drops below a certain required level, the maintenance margin, you get a margin call.
A margin call, that's when they demand more money, right?
Immediately. You have to deposit more funds right away to bring your account back up to the required level. It's the system's way of making sure that even if you're losing, you still have enough skin in the game to meet your obligation. It manages that big, two-sided, unlimited risk.
Okay, this really brings the difference home. Let's use that speculation example. Say you're feeling bullish about something, you think the price is going up.
Right. So scenario one, you're bullish on, say, Apple stock. You could buy an Apple call option. Maybe it costs you $500. That's your premium. Now, if Apple stock tanks, what happens? You lose your $500 premium. That's it. Your loss is capped at $500. Painful maybe, but defined.
Okay, option route, defined risk. Now, scenario two. You're bullish on crude oil. You decide to use futures. You go long one crude oil contract. Maybe the initial margin required is $6,000.
Now, that $6,000 isn't the maximum you can lose. If the price of oil plummets, you start losing money dollar for dollar. Your $6,000 margin deposit could get wiped out pretty fast, and then you'll get those margin calls. You might end up having to deposit another $5,000, maybe $10,000, maybe even more, just to cover the ongoing losses and keep your position open. The loss isn't capped at all.
Wow. So that's the stark difference. Paying a fixed fee for a choice versus posting a deposit against a potentially unlimited obligation.
That's the core trade-off for a speculator. Options give you defined risk, but you pay that premium cost up front. Futures offer arguably better capital efficiency. You control a large contract value with relatively small margin, but you accept that potentially unlimited downside risk.
So wrapping this up for you listening, the choice between options and futures isn't just about whether you want exposure to stocks or commodities. It's fundamentally about whether you want to buy an elective right or take on an immutable obligation.
And maybe a final thought on that obligation. It's not just for speculators. It's actually critical for commercial hedgers. Think about that soybean farmer we read about. They use futures precisely because it's an obligation. Their goal isn't necessarily to make a speculative profit. It's to lock in a selling price for their crop today, to eliminate the uncertainty of what the price might be months from now at harvest.
So they accept the obligation to sell at a fixed price.
Even if it means they might miss out on higher prices later. They trade potential windfall gains for price certainty. That guaranteed price, that locked-in obligation, is the key economic function for them. It provides predictability for their business. That's the power and the purpose of the obligation inherent in futures.